We're talking about the investment horizon here, the importance of unleashing enterprise. This has been obviously a week where the government here has been focusing on trying to unleash enterprise in its budget, but obviously with the panel that we have today, we can take a broader look, more internationally. So we're looking at, we want to talk about upskilling, we want to talk about enterprise, we want to talk about development, where people should be investing, sectors, what boards should do, all these sorts of things. And I think also we'll touch on, whether there's a backlash against sustainability for the times that we're in, and how should investments be decided? Is it just on a basis of opportunities alone? Is it on rewards? Is it on returns, on revenues? Should ESG be an impact investing more generally? Should it be the driving concern or a secondary concern? But look, to start off, what I wanted to do was to go to Ron first, and just to get us rolling. What are really the key macroeconomic forces that investors should look out for in the next 12 to 18 months, do you think?
Well, I guess I'm going to take the whole time.
No, you're not.
If that's the first question here. So first of all, Jude, thank you for having me here. There are a lot of forces out there. We heard about some of them in AI, but I think that in terms of macro forces, I think that there's really three that are dominating investors right now. I think one is the uncertainty around inflation, and in particular, what's going to happen with tariffs, and are tariffs going to, what impact will they have on inflation? Will it reset inflation expectations or not? And I think the honest answer on that is we don't know. I think if you talk to talk to central banks, you talk to the Federal Reserve, you listen to what they're saying. What they're basically saying is we don't know, and which is why you're seeing the caution in terms of any kind of interest rate change. I mean, the realities are that the tariffs have been imposed, but they haven't yet completely flowed through to the end user consumer. In some cases, you're seeing different kinds of impacts from tariffs. So, for example, probably in the US, American farmers are the ones that are suffering the most, because you've got countries that have literally said, we're not going to buy from you anymore, as some kind of counteraction. That's not inflationary, though. So inflation expectations would be one. Second, and maybe more importantly, is policy uncertainty. If we'd been in the room, if we'd been in this room as recently as 2 years ago, the talk would have been about the so-called IRA, the Inflation Reduction Act. And I remember being in rooms like this where, on the one hand, people were lauding the United States for the IRA, and at the other hand saying it was basically an extraordinary unfair trade practice, and that was sucking all sorts of investment into the US, particularly from Europe. And now look where we are 2 years later. Some of those investments are actually in shambles, and there's extraordinary policy uncertainty. If you think about some of the things that, the really big things that investors want to invest in, they're long-term in nature. And very, very few institutions are prepared to make long-term commitments because of the policy uncertainty. And then the third kind of macro theme out there is really this notion of fiscal stress and the sustainability of debt. And that's mostly around sovereigns. Again, if you go back not too long ago, real concern about corporates, real concern about consumers, particularly if you go back to the 2008 financial crisis. That's not the situation now. But it is really the situation now amongst many sovereigns. And I'll start with my country, the United States. I mean, we've got an extraordinary debt issue at a time where we've had a robust economy. And for the most part, at least as it relates to the US, an absence of war. So to be running those kinds of deficits in a period when normally you'd be building up a chest and a reserve. So those three things are probably the key macroeconomic factors. And as evidence of the impact that's happening, all you have to do is look at long-dated treasuries, right? So you've seen actually long-dated treasuries, despite the fact that you're seeing interest rates go down in the short end, You've seen long-dated treasuries reprice, and I think that has to do with these uncertainties as much as anything else.
So it's a very uncertain world in terms of, in terms of all these things that you've been talking about, but also picking up on the theme of the last panel, AI is here to just throw another spanner into the works, isn't it? We just, there's so many uncertainties there. So Eileen, tell us a little bit how boards are dealing with these challenges.
Sure. On the first three challenges, which Ron spoke to really well, we spend a lot of time on the risks on global firms in terms of how that will impact our businesses in both the short and term, long term, how it impacts our shareholders, et cetera. More recently, AI has become a much more amplified discussion at the board table than it was, say, 2 years ago. And it's amplified because when we look at what a lot of companies have done with AI, a lot of money has been spent, there's a lot of hype, and you can look at the McKinsey study, the MIT study, whatever study you want, there really hasn't been much of a return on it in terms of economics. Now, I'm sure people learned a lot, but there hasn't been much of a return. So what we're doing at the board level is, and I think most boards are doing this, is really making sure that these investments are tying into the strategy of the businesses. And clearly they're focused on productivity and growth, as well as, quite candidly, climate in terms of the boards that I'm on. So that's been a change, and it's been a much more discussed topic. In terms of when you look at where some of the other risks are, one of the things that we were very focused on, which didn't get a lot of discussion either until probably the last, I'd say, 18 months, is third-party risk. So we talk about AI, we talk about the hyperscalers being, Microsoft, Amazon, et cetera. You have new entrants who weren't viewed as that, be it Oracle and Dell. But the bottom line is there's a lot of concentration risk in terms of data for us to think about in terms of, AI and where data is stored, and are we going to continue with that? So what we're seeing is, some firms are looking at moving away from the hyperscalers in terms of part of their technology and business landscape, and they're seeing benefits of about 34% in terms of doing it that way. Now, you have to be selective in what you do and what you don't do. So I'd say that, and then the other piece that's really taken a big focus is this third-party risk, starting with, the regulators really focusing on the hyperscalers. There's more data in the hyperscalers than any individual, financial institution, which creates a lot of systemic risk. So it'll be interesting to see how that plays out over time. But beyond that, third-party risk is really one that people are focused on. So people will talk about cybersecurity. Of course, people are focused on that. They've been for the last 10 years. AI complicates it, but within a firm, you can really get around, what it is you want to do with that. When you start going into third parties, it becomes a little bit more complicated. And large companies have, thousands of third parties. So one of the opportunities, I think, for AI is really to have a specific use case on helping companies really understand their risk with third parties, which is multidimensional in terms of, there's so many things. I mean, look at CrowdStrike. I mean, somebody made a little change and it took down all these companies. Before that, SolarWinds was talked about a lot. Or Marks and Spencer's more recently. These are $100 million issues. So the boards are very, very focused on the risks, the risk tolerance, and it really, even though there's a lot of regulatory and board, and management site on third parties, and you can look at all these different, studies, and people get independent studies. It's somewhat predictive, but not really. So I think that's an area where, boards are rightfully focused on. And two, I think it's an area where AI can give a lot of opportunity. But back to your overall AI question, there has been a lot of experimentation. It's becoming much more deliberate, much more focused. And the last thing I would say we're focused on, which I think is incredibly important, is everybody, it's kind of like an AI hype. Why don't you apply this to AI? I feel like I'm going to get a pill at home when I have a headache, the AI pill, I don't know. But, we're asking people to be more productive. We need to reskill them. We need to help them understand why they're not going to be out of work. And I think that can't just be, letting people go, et cetera, it really has to be focused on in companies. And the companies I'm on, we're very focused on it from a cultural perspective and in helping people understand what these jobs can mean to them. So I'm going to come back to the AI point. AI is helping us in going through, I'm on one board that has 200,000 people, so just collecting all that information, collecting all the skill sets, collecting the knowledge on, what would people need to move to the next level. So I probably said too much, but it's a really exciting time, and it has its opportunities, but it also has its risks. And I think you have to be very deliberate and approach it like any other technology. What is the problem you're solving for? How are you going to look at the workflows, and how are you going to look at the data? Because a lot of the issues with this money that's been spent that hasn't really been well spent has really been on what problem were you solving for? Did you understand what you were doing? What was the workflow, et cetera? And those tend to be boring topics, but they need to be done to make it work effectively, and that's what we focus on from the board perspective.
Yeah, no, that's very interesting. So we've got this very uncertain environment. We've got the opportunities and the risks, but we're hearing a lot about risks from AI. But your point about people and skills and demographics, I wanted to bring you in there, Paul. This is something I know that you're looking at. How do you match those up in this age of AI as well?
Yeah, I think we're probably again entering a really exciting phase of the evolution of the investment landscape, and then also thinking about the demographic profiling. And if you look at OECD countries, demographics are against us completely, and so that either is answered by a wage inflation problem, which then in itself feeds negatively into economies, or solved by migration. Now, obviously, that's a very significant topic these days around that. So one of the fillers in the middle of it, of course, is the potential for AI to fill in there. Like in my career, I've probably been more addicted to value-based investing and that type of philosophy. And as you look at that, I think that that's probably something that comes back into vogue. I think the application of that in an AI context is there's two ways to think of AI, and if you're younger, you want to try and find the unicorn. I think if you're older, you want to find the agentic process that helps the unicorn exist, because you're less likely to pick the unicorn, but you're more likely to pick the processes that can actually help in that. But I do think that there's a significant demographic issue. I think there's we have, globally, and actually we'll have some commentary from the Gulf here later on today, you're seeing with golden visas and things like that, real attraction of talent to the United Arab Emirates in particular, and locations like that. It's not the first time in history we've seen that happen. We've seen that happen before in many different economies. We've seen that happen post-Brexit with people trying to attract talent to the various European countries with various tax incentives. And I think that drag effect is something that, so that drag effect creates a talent issue and a migration of talent. And I do think that that's ones where a government today or governments today are thinking in terms of a national interest. The problem you have is this is an international problem, because the migration effect of, like, not migrants coming to the country from desperate situations. I mean, where you're seeing talent move. I think that's going to be less controlled at the national level. And we have had some of the commentary recently on the UK with the advent of the new government. I feel a lot of it is probably a lot of hype, but you are seeing people beginning to move location because of fears of whether it's inheritance tax or whatever that may come in under a different government. So I think that these are all major factors that we now have to think about. Fundamentally, I think it comes back down to when one's thinking as an investor, I think we have to think back to the very, again, I go back to that value philosophy. You need to start attaching yourself to things that make things, that deliver outcomes, that create efficiencies. I think the whole hyperscaler debate, I think, is going to be a very, it's now bifurcated. It's either going to be hyperscalers or it's going to be, people are going to diversify their risk. My personal view is it's insane not to diversify your risk. So I think that that's where it goes. So you tend to, an algorithm tells you put everything in one place. but sensible risk dynamics tell you make sure you diversify, and we have in most countries an aging infrastructure, whether it's around how we actually handle internet connectivity and things like that, and this comes back to our point. Climatic adaptations mean that those infrastructures, grid infrastructures, all of those come under significant risk at a time like this as well. So it does bring it back to the whole area of thinking about impact and how impact investing can actually be a successful avenue for us actually to overcome some of these problems that you might have at a national level. Here in Ireland, we're rolling out rural broadband at the moment, and that's going to make a significant difference. I remember years ago I moved to Jersey in 1995 in the Channel Islands, and they had fibre optic on the islands, which was an incredible advantage, even bigger advantage because I was doing my master's in Dublin at the time, so I got introduced to the internet at a very early stage, the need for it. But I do think that they're accelerants that we need to be concentrated on, and we have to make more robust relative to the changing weather patterns that we're seeing that are coming through, just as a small example of that. So that impact focus, I think, is going to be really important as well.
And if I could just put you on the spot here, sorry, and then I think you wanted to come in, did you?
I was just going to say I couldn't agree with you more on the concentration risk, and on the impact piece in terms of energy. Using alternative types of energy will have to be done to get us into the next wave of this. And then lastly, I can't help myself as one of the aging demographics. There's a lot going on with robotics in Japan in terms of healthcare, and there's just so much going on in the world. It's amazing. It's a little bit high end, but I think as these things evolve, and then the education piece, which you hit on, it'll be interesting to see if AI.
I found it really interesting at the beginning of all this discussion of AI. Everybody reverted to whatever the last movie they saw was of computers taking over your lives, whereas the most exciting thing about AI is medical diagnostics, as you say, developing robotics, analysis. It basically is. It's going to add to the longevity patterns in terms of life. So I think it's a massive force for good. But the noise around it can distract, because people tend to come across that in a very negative way, whether it's on their social media or something like that. But I think the impact from a life perspective is going to be incredible.
I think you're right. The robotics, I know a lot of people don't want it, but I've told some family members I might prefer the robot to them, but we'll see.
I just wanted to put you on the spot before we move on to another theme, and any of you feel free to jump in. But which of these under-the-radar themes that we've been talking about, migration, health, demographics, productivity challenges, we'll leave aside AI perhaps, because that's a whole question in its own. Which of those is going to most have the biggest impact on returns, do you think, the next 3 to 5 years? Ron, what do you think?
So I'd like to, I'll pick up on Paul's talent migration point, because that is happening at the high end, but at the low end, migration is grinding to a halt, and it is a real problem when you couple that with the aging demography of most Western nations. If you look at the United States, which has always been lauded as having very different demography from the rest of the developed world, if you take out immigration, the U.S. looks just like Italy. It's no different. And for the first time since the 30s, the U.S. now has net zero migration, right? The ins are matching the outs, and that's really the last time that happened, and the only time that happened was in the 1930s. And that will have a profound impact in terms of costs, inflation. Now, sure, AI may be a substitute there, but I'm trying to figure out how AI plants lettuce. I just don't see how that's going to happen. And so the cost pressures that are going to be built up as a result of this, and it's not just in the U.S. If you think about the backlash that's occurred about immigration, certainly in most parts of Europe at this point, and I don't think people have fully factored in what that means for economies and how you think about that in terms of labor costs and just overall pressures on inflation. Now again, I think AI could have some offsetting impact to it, but I think there will be a transition period that's not going to be comfortable.
That sounds something to look forward to. What sectors then, Eileen, do you think offer the best prospects?
For AI?
No,
General.
for in general.
So I think healthcare, education, obviously technology, but I think the consolidation of those three coming together is really where I think there's going to be tremendous opportunities as we move down. I mean, healthcare in different countries around the world is really problematic. As Ron and Paul point out, we have an aging population in most of the developed countries. How are we going to deal with that? If we don't change our mind on immigration, the U.S. might have an issue as well. I think that technologies can certainly impact that. I don't fully know how much it will. And then lastly, education. I keep coming back to this. I think education is incredibly important. And if you looked at most developed countries, some, like Ireland, does it spectacularly well with education. And I'll say this for my own country, we don't do as well with education, but we spend a ton of money on it. So how do we start to rectify those things? And then in more rural areas, like take Africa. I think Africa, maybe not the next 3 to 5 years, but over time, I mean, the population's doubling by 2050. I think there's going to be a lot that goes on in Africa and other parts of the world. And so what will that need? You'll need infrastructure and so on and so forth. And you'll need investment, private and public. But in the shorter term, at least from my perspective, I think this, we talk about, is this a bubble? Is it not a bubble? And I lived through as I'm sure most people here did, the previous bubbles. People that did things well and thoughtful got through the bubble and they were there afterwards. So I think being planful and so on and so forth. So I don't see this so much as a bubble. I see it as an opportunity. And I think that in technology, healthcare, education, we'll see a lot of changes. And then, of course, AI will impact sectors like financial services, pharmaceuticals, et cetera. We're already seeing it. And so how we do that, and I can't say this enough, because if you ask me what my biggest worry is, how do we re-educate people? And how do we make it an opportunity for them versus a fear in all of those sectors? So I think it'll be pretty broad-based, personally.
So it's broad-based in terms of sectors. Ron, let me ask you about, how do you balance the risks? We're in an era of perhaps slowing global growth. Interest rates are changing as well. How do you look at asset allocation between developed and emerging markets?
Yeah, well, we've seen this period where there's just been extraordinary U.S. dominance, and asset allocation was pretty easy. If you were overweight to the U.S., everything was going to work fine. And that led to all sorts of, I think, valuation mismatches and things like that. So in some ways, we're probably entering a period of rebalancing and getting back to normal here. And you've seen that. You've seen that in terms of returns. You've seen it in terms of asset flows. I've actually been given our role as we're a very large custodian, so we see where the money goes. And there was a move to take that overweight position in the U.S. down. Interestingly, that stopped since April 1st and Liberation Day. I think it's once the bad news is out, then you know what the bad news is, and you have a little bit of certainty around that. But I think you will see an appropriate rebalancing. Firstly, back to other developed countries, and more importantly, back to emerging markets. In some ways, emerging markets are probably as well equipped as ever to weather what's facing them. They certainly don't have the debt issues that they've had in the past. They've become very adept at managing their own currencies and providing hedges in place. And again, there's a lot of innovation. There's youthful populations there. I keep coming back to demographics, but if you think about, the young are the people that get things going and make things happen. So I think you'll see actually a move and a rebalancing back to a more equal weight around the world. But I think the challenge for investors is, despite everybody's displeasure, or most people's displeasure about what's going on in the U.S., you've still got extraordinary innovation happening there and very profitable companies, right? They know how to make a profit. So I'm not at all saying that one should disinvest from the US, but I do think that there's more opportunities now than ever.
I did like your mention of back to normal. I'm not quite sure if we know what normal is anymore and whether we'll ever get back to whatever it was. I wanted to also ask, while we're in this sort of, where should assets be allocated, what about private markets and public markets? I mean, who would like to jump in on that? Is that, Paul, would you like to?
Yeah,
how do you see them, which do you see performing better?
Well, the good news within the business that I set up with a couple of founders a few years ago, we made a decision at the very beginning to have a balance between private and public. Unfortunately, we weren't balanced on the public side because we just have a propensity to try and find value managers because, our view was that, if you looked at the public sector, you were on this drug of low interest rates for so long, benign inflationary environment. It had to change. You talked about going through the bubble cycles. I arrived in the market in '86. Wondered why Bank of Ireland asset managers weren't invested in Japan because it was rocking the world, weren't invested heavily in the US. And then suddenly Japan disappeared from 40% of world indices to 10% and never really recovered much beyond that over it. So I started my career believing that bubbles were a part of life. And the reality was that's, no matter what they say in this last 40 years, you've had US healthcare, you've had Asia crisis, you've had LTCM, you've had dot-com bust, you had this financial crisis. You don't really escape them. So in terms of how you think about a portfolio, I think it has to be on a more balanced basis. So it tends to be a discussion about a decision between public or private. Whereas I think the decision on public is how much do you want to do to harvest beta on the public side, and then how much do you want to do to actually chase alpha. I do think this latter point means that I think active managers will come back into vogue. I think managers will make real decisions, like 25, 30, 40 stock portfolios, with strong thematics within that. I think that they will really matter. On the public side, when we set up Havengreen in the first place, we were focused on sustainability and led investing, and we just hoped that we would have to drop the word sustainability at some stage and it would just be called investing because that's the right thing to do. But I do think actually we've had a little bit too much interference around the regulatory side. It's probably made it more difficult here in Europe. ESG investing is getting a pounding. It's obviously getting a pounding in the US as well for different reasons. But the one thing I think that is shining through is the whole area of impact, because it's really measurable, and it's it's tangible. So I think on the private side, I tend to agree on the private side. I think the opportunity in PE, if I look at it today, is probably US and US mid-market PE. I think is probably one of the core areas that, no matter what happens or what governments in the US, that whether it's the Inflation Reduction Act or under the current regime, it's going to drive that US mid-market space and particularly in buyouts. I think that's really exciting, continues to be very exciting. I think these mega funds that are coming out on that, which just have to buy massive companies for the funds to get their returns. And I think you're seeing an averaging down of those PE returns. I think it again come back to skill, and skill is limited. Skill is not running a 10 billion fund is different to running a 1 billion fund. So I think skill is going to really matter. So I think there'll be a balance, and I think, private is definitely here to stay, and it's here to stay. And I am a little bit fearful about the secondaries exits on those markets at the moment. I don't think some of those markets are some of those valuations are getting justified. We now have the emergence of continuation funds. Every time we innovate something in the asset management industry, I get a little bit nervous as, are we innovating it for the benefit or of the actual investors who we have an obligation to, or are we just trying to extend the lifetime of something in an industry which we probably should mark down? And I think actually that question will get answered with time, but I'm a little bit nervous about that. I get very nervous when I see us developing public-private market strategies into that go deeper in towards the retail space. I think it's very important that retail investors get the opportunity of getting the private market premium, but I think we have to do it in a way that the responsibility from an industry perspective has to be taken really seriously, because these aren't people who are automatically armed to discern between the risk of the strategies. The long-term illiquidity premium, I think, justifies in terms of a balance that your private allocations in your portfolio should continue to rise in the longer term. But then we saw in the UK, when we had that event with the budget quasi-quartang a number of years ago, and Liz Truss as the Prime Minister, you basically, within one fell move, you moved within 3 months of that, most people were liquidating their public equities in a dramatic fashion to match their LDI. So an event like that means then private markets, you have to be careful of how dominant it is in your portfolio. And then, sorry, not to monopolize, but I think you also have to think duration and timeline. You invest in public equity markets because you expect a 3 to 5 year return. You invest in private markets because you're looking 7 to 12 years. And you have to have that mindset between the two. So it's even like the example of impact investing and what the team at Venturewave will do. When we all participated at the beginning, we did so eyes wide open that, you're on a journey on these investments and you're bringing them for very early stages onwards. And, that requires a patient investment approach. And I think actually that duration call between how people think of their portfolios is something that's not emphasized enough. And when people are considering that allocation effect.
I just wanted to pick up on one point that you made there before we open it up to the floor. Is the focus on investing in ESG and sustainability, is that dead? Eileen, maybe you could bring that
I don't think so, but I was an investor in it about 6 years ago. I think you have to look at what's profitable. And I think that Paul just gave an excellent dialogue on, in terms of allocating your portfolio, et cetera. So no, I don't think so at all. And when I look at different countries, I was just in India a couple of weeks ago. Even in India, who 2 years ago, well, this is recorded, but anyways, wasn't really focused on ESG. They are getting focused on it. Their economy is growing rapidly. And so I think different parts of the world are waking up and seeing the impact of not being focused on it. I mean, I can't think of any other topic that scientists around the world actually agree on other than this. And I've seen time after time opportunities where this is really, really profitable. In addition to some of them, I think it's just the right thing to do. So I think that it's gotten a lot of beating down in certain countries because of not so much ESG, but other pieces of this, be it DE&I, et cetera. Some things may have gone a little too far. And so I think it's here. I think it's here to stay. I know it's taken a bit of a hit, but I'm a big believer in it. I've benefited from it, and I think it will continue to be the way to go.
That's very encouraging.
Yeah, I would underscore that too. I think we've actually moved into what I think is a healthy phase here, which is rather than call it out as a distinct product,
Good point.
Which always tends to, anytime you call an investment product out as something distinct, usually that's the time to short it, right? What's happened now is these factors are being incorporated into investment risk frameworks, and that's exactly,
so it's already there.
It's exactly where it should be. And I don't know of any investor who hasn't incorporated climate into their investment risk framework. And you think about it differently for different companies. For a bank, if you're investing in a bank, you think about, well, what's in that portfolio that we should be worried about? What are your exposures there? You think about investing in an insurance company. So it's where it should be. Governance, what investor doesn't think about governance, the G side of ESG, when they're making an investment?
Yeah.
So, and then on the on the diversity, equity, inclusion piece, that comes to me about talent, and what investor doesn't think about the talent strategy?
So it's just the labels companies that perhaps have
exactly,
changed, not
and
the
so
emphasis.
in my mind, it's moved to where it should be, which is into the investment committee and as part of the investment risk framework.
No,
I agree with you, and maybe what I'm going to say is not popular, but I think that it couldn't agree more on the DE&I piece of it. I think it's moved towards talent and performance and away from quotas. And just speaking as a woman, I really appreciate not being a number and rather be looked at from a performance perspective. And I think that's where we're migrating to.
No, that's right. That's right.
Very good. Well, look, do we have any questions from the audience here? Don't be shy. Oh, well, look, while everyone's thinking, there was another question that I had wanted to ask you and we hadn't got to yet, which is just about the investment opportunities that the energy transition represents. Who wants to come in first on that?
So, I mean, the prior panel talked a lot about this in terms of the massive investments in energy that are required to fuel this, this AI boom. And I think that, and real concern about that on a number of dimensions. One, just the sheer amount of resources that are being sucked into it. Two, what are the climate implications of all that? I think that the other thing that we should also be thinking about too is I suspect that we will see a lot of energy innovation, right? I mean, part of why are we investing in so much power now? Because right now with the chips we have, we know the power, we know what the power requirements are. Well, might there be a different chip? I mean, I suspect there's a lot of innovation going on right now to think about chips that can operate faster, operate at lower temperatures, and basically operate with less power consumption. Mm-hmm. So maybe I'm overly optimistic here, but typically in these times of need, right, there's an innovation. Somebody thinks about an innovation or a group of people think about an innovation. I mean, if you go back to I think it was the mid-90s, in many parts of the world, they were talking about this impending electricity kind of supply gap that was going to happen. And then the developed world went through almost 20 years of electric power demand growing at less than 1%. What drove that? The LED light bulb drove that, right? So, I mean, it sounds trite to think about it, but that's exactly what drove that. So whether there'll be something like that that will be so dramatic, I'm not sure, but there are a lot of smart minds thinking about how we're going to actually accommodate all this AI at a far different price than we have now. I think so.
Did you want to come in there, Paul?
I think actually, so one of the interesting aspects of the debate around energy and the whole transition, it became, again, as we tend to do, bifurcated. Like, you're either all renewable, and then we have all this just stop oil, all this, like total nonsense at the end of the day, because it cannot be achieved without a transitionary effect. The big danger, and I think it was a great moment there, I heard on the news there in the last few days, where renewable energy power generated globally overtook coal for the first time ever, which is like a remarkable achievement, and it shouldn't be underestimated, because it effectively means at least a 50% reduction in the coal output that from whatever starting point we had. I think the danger, of course, was that we just went solar, and then you saw in Spain where you had that power outage. So what is happening is we're running hard on solar, wind. We're not running hard enough on battery storage. We're not running hard enough on how we back up grids. Grid stability is critically important. In my prior role at Morgan Stanley, we actually spent, one of our big projects was redrawing the grid network in Chile. And I mean, that was just an incredible project to be involved in, and creating that grid stability. And you don't underestimate, in mountainous territories, you actually end up with 3 grids in your country, and trying to get those connected. Even the UK has this problem with the Pennines, that you actually have 2 grids, north and south, and making sure that you could have a stable southern grid, but an unstable northern grid, and how you actually work out the balance between those. So, like, the optics are solar, wind, offshore, onshore, people gluing themselves to motorways, or doors of offices. The reality of it is like the sensible middle ground that doesn't do these protesting realizes it's all about transition, and it has to be all about grid stability. And if you haven't got the grid stability with fast means of gas power generation that can catch up when you have a surge in the evening or a surge in the morning, everyone's going to have problems, as they did in Spain with the.
Well, yeah, and if you look at fossil fuels, they've been around for the last 120 years. They've had a long time to become efficient. Mm-hmm. And to Paul's point, solar, et cetera, is starting to become more efficient. And so we're really getting there. And there are things, we talk about data centers and what you need there. There are smaller, greener data centers that can be put closer. So I go back to Ron's point. We've had a lot of problems in the world over history. We somehow figure out a way to get through it. And I think we will, but it looks very daunting until you have the solution. Mm. But I think your point, energy is a tremendous opportunity,
Tremendous
which is
investment
being not
opportunity.
just fueled by technology, but most of the Western world has pretty old grids. And there's things like wave technology that could, you know, in the United States, power both coasts by 2/3, but, you know, there's the money, et cetera. Anyways,
So it all needs money. So we still, oh, gosh, we are pretty much out of time. Is there any quick question from the audience at all? Well, reluctantly then, I think we're going to have to wrap things up because we are out of time. Does there
Thank you,
anything-
Jude.
No, thank you very much to my panel. I think it's been a fascinating discussion. We've got plenty of material. We could have carried on talking all day, but thank you very much. Please
you.
join me in thanking them.